Hello distinction students, this is your commerce tutor Miss Zulu. Welcome to today's commerce session where we're going to look at the topic financing of business units. But before I get into that, remember to subscribe to my YouTube channel for more sessions. Okay, so what are some of the reasons why a firm may need additional finance? Okay, so when there is need to expand in the existing business, so meaning when you have a business that has been going on and you want to expand it, there is need to have this financing addition, right? And then the other reason is when there are unexpected business bills to pay. Okay, when there is need to replace equipment, so let's say you have been operating with these certain equipment and some of them are maybe out of use or you need more equipment. Okay, it might be needed to survive a crisis in a business. Let's say maybe a business might have foreseen a loss, and then this might help out, this additional finance might help out. Okay, so when there is need to take over another business, let's say you've been running a business and you need to take over another business. Okay, when the firm has run short of money to pay for the goods and services. All right. Okay, so let us look at the factors a firm considers before choosing a method of financing business. Okay, so the first one is the amount of loan needed. So let's say this particular business wants a certain loan from a bank for them to finance their business, right? So they look at the amount of that loan that is needed. Okay, the rates of interest charged on borrowed money. What are the interest? When I borrow this amount of money, how much do I have to retain back as an interest? Okay, so you need to consider all those things. The period of loan repayment. Okay, like how long is it going to take me for me to repay back this loan? You need to consider all those things. The amount of money available to lend out. Okay, the collateral security required. So we know most of these companies that are loan based, they need collateral for them to lend you that money. Like what security is required for that collateral? Okay, the purpose or reason for borrowing money. Okay, how previous loans have been used. If you have borrowed a loan as a business, how did you use the previous loans? You need to consider all those factors. All right. Now let us look at the methods of financing businesses. Okay, the first method we're going to look at is trade credit. So what do we mean by trade credit? When we're talking about trade credit, this is an arrangement whereby a trader is allowed to purchase goods and then sell them to another increased price before paying for them. Okay, so let's say this trader will buy these goods and then this trader is going to sell them at an increased price. Okay, and then let us look at the other method, which is the hire purchase. So when we're talking about the hire purchase, this is a method of financing the purchase of durable goods. When we talk about durable goods, we're talking about, for example, I would say furniture, I would talk about machinery, I would also give an example of a car. Okay, the third one is bank overdraft. What do we mean by bank overdraft? So bank overdraft is a method of financing day-to-day businesses expenses. So when we're talking about these business expenses, we talk about purchase of additional goods for resale, for example, maybe paying electricity bills, okay, and so on and so forth. Then the other one that we're going to look at are debentures. So when we're talking about these ones, so the fourth one is bank loan. Okay, so when we're talking about a bank loan, this is a method of financing capital projects. When we're talking about these capital projects, we're talking about projects such as purchase of a motor vehicle. We're talking about projects when you're trying to expand a business. We're talking about construction of new buildings. We're talking about purchasing of new machineries and so on and so forth. And then the fifth one is debentures. So when we're talking about these ones, these are long-term finance for purchase of premises. We'll talk about purchase of a heavy machine. We'll talk about construction of new buildings and so on and so forth, okay? So when we're talking about these debentures, these are loans to a company and they are repaid on fixed dates, all right? So you have a fixed date on which you have to pay back these loans, okay? Number 6, we're going to look at mortgage in property. So this is a long-term finance obtained by getting a loan from a bank or building society which is secured on assets. So when we talk about assets, we're talking about assets such as a house or land. Okay, Let us look at 7. 7, we're talking about factoring. So factoring is a method of financing businesses that sell goods on credit to customers. Okay, so I would say a company would sell goods worth 50 million on credit to customers. Okay, that's an example. Then number 8, we look at share issue. When we're talking about share issue, this is a long-term finance used by a limited company. Okay, so for example, a limited company, this could be maybe for equipment, it could be for large projects. Okay, financing large projects. Okay. Number 8, we talk about government grants and loans. So when I'm talking about this government grants and loans, it finances some businesses by means of grants and overdraft. So when we're talking about a grant, this is the amount of money that is given to a business, usually by the government. Okay, so this money is given maybe by the government. It could be given by large corporations. It could also be given by NGOs. Okay, then when we're talking about an overdraft is a banking facility in which a bank allows customers to withdraw money from their account even if their account is zero, like they have no money in their account, or if the money that they have in their account is less than the money that is needed for them to withdraw. Okay, let us look at bills of exchange. So when we're talking about bills of exchange, is a method of financing traders or trades engaged in foreign exchange. All right, let us now look at balance sheet. Okay, so a balance sheet is a financial statement that allows the assets and liabilities of a business, including the owner's capital, on a specific date. All right, let us now look at the assets. When we're talking about assets, these are properties of a business that have value for generating other assets or may be used to run their business. For example, we have examples of assets. We have goods for resale, we have cash at bank, we have motor vehicle, we have cash in hand, land, building, etc. Okay, so when you talk about assets, there are two different types of assets. Let us look at them in detail. So there are fixed assets and there are also current assets. Okay, so when we're talking about fixed assets, these are properties of a business which are bought to be used in business permanently over a long period of years. So when we're talking about examples of these fixed assets, we're talking about something that can be used for a very long period, right? We're talking about buildings, we're talking about land, we're talking about motor vehicles. Okay, then when we talk about current assets, these are properties of a business whose value changes from day to day. They are short-term assets that can be turned into cash easily or can be used in operation of business within a period of 1 year. Okay, so that's the difference. Fixed asset for a long period of time. We're not talking about current assets for a short period of time, right? So what are the examples of these current assets? We have cash in hand, we can say cash at bank, debtors, and stock. Okay, let us look at liabilities. So these are amounts owned by the business to other people or organizations. So when we're talking about liabilities, they are classified according to the length of time they are to be repaid by the business and falls into two categories. We have the current liabilities and the long-term liabilities. When we're talking about a current liability, these are short-term liabilities repaid within a period of less than 1 year. So an example would give about current liabilities. We have creditors, we have bank, overdraft, we have outstanding bills such as electricity bills, okay, and so on and so forth. So, and the other type of liability is long-term liability. So these are liabilities owned by a business for a period of more than 1 year. They are amounts that have to be paid after a number of years. Okay, so when we're talking about these, we're talking about mortgages on premises, we're talking about bank loans. Okay, let us look at the types of capital. So the first one, we have the capital owned, which is also known as owner's equity. So when we're talking about this capital owned or the owner's equity, this is the amount remaining after the value of all liabilities is subtracted from the value of all assets of a business. So for example, we'd say capital owned, or maybe owner's equity is equal to assets minus liabilities. Okay, and then the other type of capital, we have capital employed. When we're talking about capital employed, this is the total value of a company's fixed and current assets, rather whether they are borrowed or not. Okay, the third one is fixed capital. So when we're talking about a fixed capital, This is the money invested in fixed assets which enable production to take place and also help in the generation of profits. Okay, the last one, the other one we're going to look at is working capital. When we're talking about working capital, this is the amount by which assets exceed current liabilities. Okay, so we're talking about working capital is equal to current assets minus current liabilities. All right, let us look at business calculations. Okay, so terms used in business calculations, we have the turnover. When we're talking about the turnover, this is the total sales less returns. So this is the net sales of the business during a certain trading period. Okay, so now we're meaning when we're talking about the turnover is equal to sales minus sales returns. Okay, or turnover is equal to cost of goods sold plus gross profit. Okay, sales return, also known as returns inwards. So when we're talking about sales returns or return inwards, these are goods sold to customers which they return to our business. Okay, and then the other one is purchases. When we're talking about purchases, these are goods brought by a business for resale during the certain trading period. And then the last one is purchases returned, also known as returns outwards. So these are goods bought from resale by the school, maybe for example a school tuck shop during a school term. So thank you for watching my video. Make sure you subscribe to my YouTube channel for more sessions.